Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on October 28th. My name is Ian Saunders. Thrilled to be back here, back on the podcast with you, Will Gibson, especially back in person. Yeah, thrilled. It's a treat. We have Halloween coming up this week, so this will be a nice little treat.
You always have really good intro for the podcast, like all these little punny things that you throw in.
Yeah, I'm just
That's a staple about Ian Saunders on the podcast.
Hopefully everyone's not tuning out after that. But when looking at some of the market returns, there's been definitely some reasons to kind of tune in over the course of the past week. Looking at some of the major market indices have had a solid past week of market action. I mean, S&P's up over 3.5% over the trailing 7 days. We'll get into some other areas. The Dow's up 4.6% over the past 7 days prior to market movement today. NDX up over 2.7% over the past 7 days prior to market movement. Again, today, as I say today, it's recording this podcast on Thursday, the 27th. And some of the more growth-oriented, tech-heavy Nasdaq Composite and NDX are not having too great of a day today. The broader Nasdaq Composite down 1.5% on the back of some pretty major individual stock moves, which we'll get into a little bit later. But nonetheless, some of this improvement we've seen throughout the course of the past 7 days, really kind of past month, right, has led to some notable indicator changes that we've seen. And I mean, some of the returns haven't been too shabby.
Yeah, we've seen some good moves, like you said, out of the major indices. Some of the indicators for sure, like the S&P default chart doesn't look half bad right now. A couple consecutive buy signals, a little pullback today. Looks pretty healthy.
We did just change those default charts, right?
Yeah. So we did change the default charts, not to bring too much attention to it, but we did mention those in our report a couple of times. Really nothing material, just taking out some of the market noise. It's really bringing you to a more, what we would argue, holistic picture of what's going on.
Yeah.
So highlighting that 20-point chart is the default on the S&P now.
And pretty much every time we talked about it on the pod, we talked about the 20-point chart.
Yeah.
So it's something that we defaulted on the analyst team too, right?
Yeah.
Now it's just the default on the site.
Yeah.
And
we didn't change any of the rules, point figure. There's nothing mechanically that changed on the system.
Yeah.
But just we argue a much better way of looking at the default. You can always go back and change it if you really love the 10-point for whatever reason. You can go back and change it, but that's a bunch of minutia jargon. Some people probably don't care about that. So I mean, chart movement itself over the past couple of weeks doesn't look half bad. Higher bottoms, nice little pullback today.
2 consecutive buys. I mean, you got right back. I mean, we're oversold. Got right back to normalized position. I mean, smack dab middle of the trading band prior to today's move, and then pull back right down into a column base.
Yeah. I mean, most of this year has been spent on the oversold side. You saw like the March, the June, the August, and then maybe an October type of run. I don't know, but anyways, you brought up participation stuff, and I want to get to that as well. Index wise, headline has been better than usual. Oh, actually, I want to mention calendar year returns on the S&P before we get to the index.
Where are we at right now?
Yeah, if we were to end the year, we'd be down. This is through yesterday, so the 26th.
Okay.
So by someone listening to this, who knows what it's at, but down about 20% would be the final figure if we ended on the 26th. That would be your worst year since 2008. Granted, 2008 you were down 38, so a far cry from 38% is 20%. Still not a great year. We were chatting before this. If you look at like the past 15 years of S&P 500 calendar year returns, there's only been 5 years that have not seen a double-digit gain or loss, which feels extreme to me, especially when people are like, "Oh, the market average is 7% a year."
Yeah,
that's pretty notable divergence from that.
A double-digit gain or loss. Yeah. So we were looking at some of the returns. I mean, it's hard to admit. 2011 we're flat.
Goose egg.
0.0 in the year, and then was it 2015? I think we were negative 0.7%.
Yeah.
That would be nice if we got back to that point this year. I think everyone would say that would be a pretty nice finish to the year.
Yeah.
But yeah, certainly not the case with movement we've seen in the past few years.
Yeah. I mean, and October is known to host some pretty notable bear market bottoms. Also, very much a hate relationship as well with the month of October, as we talked about. But walking into some of those participations, we have seen maybe some type of bottom formation happening. I know we've seen that a number of times this year. These things go down, reverse up, go further down, reverse up. I think a couple of the more notable ones are on the positive trend front, like the positive trend for the New York Stock Exchange We'll throw a chart up on YouTube, but it's showing the percent of NYSE stocks above their bullish support line or trading in a positive trend reversed up to 30% after hitting a multi-year low of 24%.
Lowest level since 2020.
Yes, lowest level since 2020. Granted, 2020 did go to 8%, but the only other time you've actually gone to 24 or below was the 0809 market environment.
Even the early 2000s.
Yeah,
wow.
Early 2000s didn't get it. Only 0809 you went there. 2015, 2016 you didn't get there. You stopped at 26%. 2018 you also didn't get there. So interesting you've seen this amount of deterioration. Granted, 08, 09, and 2020, you saw this thing go way lower before you actually reversed up. But nonetheless, positive movement for that particular indicator. Also on the New York Stock Exchange front, I want to highlight the multiple buy signal for the bullish percent. So that's the percentage of stocks trading on consecutive point and figure buy signals. That also reversed up following yesterday's action to 12%, coming up out of 6%, which was also its lowest level since 2020. And the only other time you've gotten there was 0809. So pretty notable clustering, I think, here from some of those environments.
Yeah, absolutely. I mean, and you don't see the positive trend chart, or certainly the multiple. You don't see those move all that frequently, right? We talked about a lot of other indicators, especially on the bottom, over the course of the past few weeks. Some of the more near-term focused ones, like the 10 weeks, your high lows, stuff that got super washed out, right? Even though we're not at those levels, I mean, you don't see the positive trend charts move that much. We've seen it had, what is this? 1, 2, 3, 4, 5, 6, 7, 8 column changes, including the most recent one. So far this year.
Yeah, 4 down, 4 up. Is that right?
I believe so. Yeah, 4 down, 4 up. Which we saw 1 in 2020 or 2021.
2021,
right? 2022, 2020, you saw 6, I believe, if I'm counting that right. 7, 7 in 2020. So you just, even in these heavily volatile years, meanwhile, we're looking at multiple double-digit column changes for like the bullish percents, right? You just don't see the positive trend charts move as frequently. So the movement, when they do occur, tend to be pretty noticeable or notable indicator shift.
Yeah. So I think that one's moving in the right direction. The PT for the New York Stock Exchange, that is typically we want to see that above 50, above 60. That's where you get your best kind of market environments, but we're moving in the right direction now.
Yeah. And a lot of that, when we were talking about what's kind of drawing that, right? What's creating that movement? A lot of it's been on the small cap front from what we've seen. I mean, we're seeing more names potentially in the small caps kind of pushing back towards those trend lines, at least, as can be seen in some of the broader ETFs, like looking at IWM, that broader iShares Russell 2000 ETF. I mean, still a weak fund score, 1.43, nothing to write home about, right? There's a lot worse fund scores on the platform.
I could name 5.
Yeah, but still not strong, but it's shown some near-term improvement. I mean, it found a bottoming formation actually back in June of this year at 164, and then rallied all the way back up to 200, fell back down to, guess where, 164, 3 more times over the course of the past few months. It's pretty solid support down there at that 164 point. We're now have gotten 2 consecutive buy signals and are bumping right up against that longer-term bearish resistance line. Current chart level 182 would break through back to a positive trend at 184 potentially if we continue to get improvement from there.
Yeah.
So yeah, it's pretty interesting chart to look toward. It's been a couple other times this year we or one other time we pushed through to a positive trend back in August. So this rally from small caps isn't unprecedented this year. But we'll see if this kind of move can be sustained moving forward.
Yeah, I mean, they're up 1% today, IWM, that is. So pretty notable divergence from your large cap space. Another fund that I was looking at, if you look at IJR, actually puts like a profitability screen on the universe. That's back into a positive trend as of this week. Three consecutive buy signals. You also have some pretty good support, like you mentioned, Ian. Different price level, of course, but around 87 for IJR. So pretty constructive movement from small caps that we've seen.
Yeah.
I know Brian Joyce and I talked about this last week on the podcast. If you didn't listen to that one, I definitely recommend going to listen to that, hear what he has to say and think about the market. I think he's a really wise technician. But he was mentioning maybe some of the reasons that you've seen the small cap resilience compared to the larger cap could go down to the US dollar, where a lot of small cap companies, their international clientele or their international exposure is maybe much lower than a lot of large cap companies that have a very globally diversified client base. So products being much more expensive for more of large cap
Mhm.
company clients versus small caps. I thought that was a great point that he made.
Yeah, definitely a great point. If those that haven't listened, be sure to go back and check that out, available on YouTube and where we're hosting the podcast as well. But yeah, definitely a solid point there on the small cap front. And I mean, we've seen the story throughout small caps kind of outperforming large caps a little bit more recently. One thing that's been a little more consistent throughout the years on the value growth side of things.
Sure.
I mean,
Yeah.
if I know we talked about it earlier, but we were talking about the year-to-date performance for some of the broader value funds, RPV, the broader value fund, down 4% this year. Would not have guessed that.
And
if
that's
you
before today.
That is before
And
today's
it's up like
1%
1%
move.
today.
That is yeah. So it is a sharp improvement for RPV, to say the least.
I was
over
shocked.
the course of the past few weeks.
I wish we were recording when we were planning this, and I was absolutely shocked. If someone asked me what RPV is down for the year, I probably would have said, I don't know, 12, 13, not 4.
4, yeah.
I mean,
and it's with today's move, talking about positive trends, right? Leading into today, RPV is one of the strongest scoring kind of broader market, certainly broader market S&P funds. 4.77 fund score, has a positive score direction. As we mentioned, only down 4%.
And
up a percent.
A 2% yield.
That's true. 2.4. But with 10 years touching up to 3.5 or 4%, you know, that doesn't have the same weight it used to. But in looking at it, I mean, coming off a bottom, we have a kind of not a classic triangle, but a triangle looking formation after bouncing off a bottom down there at 70 in today's move. Talking about positive trends, breaks back through to a positive trend with today's move up at a chart level of 78. So you've seen a solid bounce, and it's, I mean, still relatively normalized on that.
Is it the first time it's actually going back into a positive trend this year?
Since it broke through to a negative trend in June, and yeah, it's tested several times. It's a good point, back in August before falling lower, and yeah, this is the first time it's broken back through it.
Discovering stuff on the podcast.
Look at that. Heard it here first.
Yeah, that's huge. I mean, I think value, equal weight, like you could see the same thing, like RSP has held up a lot better than its cap weighted counterparty. But then I know we want to talk about, you talk about value, it's like you have to talk about growth.
Yeah, and if you look at those two things on an RS chart, it's a pretty consistent RS chart up until 2020. Which, as is most things, so you could talk about up until 2020, the XYZ.
Yeah, it really messed up a lot of the charts.
Yeah, but in looking at that, I mean, you go back to 1996, right? I mean, when you change signals on that RPV, RPG, RS chart on 3.25 scale, it tended to be relatively consistent, right? You move to a buy signal on that chart in November of 2000, and it gave 5 consecutive buy signals leading into 2008. Moved to a sell signal in 2008, gave 5 consecutive sell signals leading into 2020. And then heading into 2021, moved back to a buy signal in March, and we, over the course of the past 18 months, got a little bit of flip-flopping back and forth. Buy signal, sell signal, sell signal. Now we're back to a buy signal. We're close, not quite there yet. We got a reversal back up into a column of X's on that chart earlier about 10 days ago. So a couple weeks ago there in October, and it's getting closer to giving a second consecutive buy signal, which we haven't seen since the early 2000s.
Dang, yeah. And just to be clear, the chart we're talking about, when on a buy signal, is RPV being favored over RPG. Yeah, that's a huge note. Not a consecutive buy signal since the early 2000s. Yeah, that's huge.
Yeah, I mean, it's not there yet. And we've seen many things. Hey, we could do this, and it hasn't gotten there yet. We got very close in 2021. I think I remember talking about that. We formed a double top on that chart in May of 2021, turned right back around and headed further south. So just because we're close doesn't mean we're going to get there. But it is an important, it could be an important thing to monitor heading into the end of the year.
Yeah, if I were to have an RS chart on my widget, which I do, this would be one of them.
There you go.
For sure.
Yeah. Yeah, and a lot of that's because of value resilience. I mean, we talked about it only down 4%, a little below 4%. But a lot of it's because of growth weakness, right? I mean, that's some of the other areas, some of the big names. We assumed that some of the highest allocations within RPG would be some of the bigger names reporting earnings this week. And I think that's another point that we were a little surprised about when we were preparing some things for this podcast.
It just goes to show that we don't know what we think we know, and then learn something new every day, for sure. I mean, I mean,
your top 4 holdings in RPG are all energy names. Would not have guessed that from an allocation perspective, but hey, I mean, you're looking at Meta, right? The 4th lowest allocation, 0.8% of the portfolio. Obviously, Meta is a name that I know we wanted to touch on a little bit. Seen quite some interesting movement over the course of today, really coming off the back of earnings. Stock was down, what, 27%, I think, at its lowest point. It's currently now down around 24-25% at the time of this recording
Come back.
on Thursday. So a couple percent up. But that is not a pretty looking chart.
Gosh, no, yeah, that's bad. I mean, I know we were talking about this earlier, but the technicals coming into the year, we're not peachy either. So if you look at that historical tech attribute score for Meta, so January 1, you're coming in the year, and it degraded pretty quickly. So January, like the first day of trading, it was a 4. Then it fell to a 3 on January 10th.
Okay.
So it moved to a hold
You
from
got
a
it.
buy pretty early.
Yeah.
And then January, late January, early February kind of flickered between a 2 and a 3, which would be like a sell and a hold, respectively. And then since February 3rd of 22, it's been a sell attribute stock the whole time.
Since when?
Since February 3rd.
And that was the day
2022.
you moved down from a chart level of 328 down to a chart level of 220
They'll do it.
in
Yeah.
a day. And I remember looking at that being like, I mean, we're heavily oversold. It can't go much lower from there. Current price is down at 97. So,
Gosh, yeah.
Or 98, sorry. So it's just because it's low or oversold doesn't mean you can't go lower.
Yeah, that's one that you think that it can't keep going lower, and it has. And like a bunch of the other stocks, energy stocks, like you think they just can't keep going up, but they have. So yeah, I mean, Meta's been a huge eyesore from a charting perspective this year.
Yeah, would add. I mean, it is today's move puts it in a heavily washed out, heavily oversold territory. So might expect some kind of near-term bounce from these levels, but just because it's oversold doesn't mean it's time to be jumped in and buy it. Certainly.
Yeah. That's a case where if you need to get out of this, maybe it's a sell on rally type of candidate for sure. I mean, year to date, it's down over 60%. Is that right? 60%. Yeah. I mean, that's rough. That's really hard. And I know that's probably a long-term holding in many portfolios. I think I saw a stat. This is actually below. Actually, no, I'm not even going to go there, but it's below some level that it was never been below before.
Yeah.
You're below 20, you're below 18, you're below.
You got to go back a ways. Multi-year lows.
Yeah.
And I know, I mean, it's not the only name that shows some weakness. I mean, just looking at some others, and this is coming off of Meta reporting earnings yesterday after market close. We won't go into kind of the details of the earnings, but obviously the market not liking it. Another thing that the market did not like this week at all were earnings from Alphabet, with shares of the Class A, GOOGL. I mean, it's a 3 for 5 from an attribute perspective, still kind of hanging on to that final attribute. But it's a pretty consistently weak chart. We see some consolidation. I know David talked about this on our rundown call I believe it was Michael or Miles was talking about this on our rundown call yesterday. You see some consolidation, move lower, consolidation, move lower, consolidation, move lower. And now we're in the final consolidation around the mid, kind of creeping up back towards the midpoint. Might start testing to go back to a positive trend, and we're back down at the low 90s now. Really kind of consistent stair-stepping move lower here for Google.
Yeah, I thought it was a good call out by him as well. Those consolidations and drop lower. We'll try to highlight that for the video today. I mean, it was down 5% yesterday, 6%, something like that. Down another 3 today. I mean, these are big names to be moving that much in 2 days. So this is also why you want to incorporate some type of absolute trend analysis into your process. So yes, it's a 3 attribute stock because relatively speaking, for at least most of the year up until this point, it was holding in there pretty well. And especially beyond that, relatively speaking, it's held up and been a great performer. But looking at the absolute trend breaks, sell signals, that's where you can really get some additional insight about weakness. So that one's taken out support at 95 today, down to 93, which is your lowest level since February-ish, late January of 21.
Yeah, and I know another one that has not reported earnings at the time of this recording on Thursday, but will have reported earnings by the time this podcast is released on Friday morning, is another the biggest stock in the world, kind of an important deal, right? Apple, ticker AAPL, has shown a lot more resiliency than a lot of other big tech, pretty much most other big tech areas. I mean, still down 15-16% year to date prior to today's 3% down move. On a buy signal. Right, still in a negative trend, but it has not seen the technical deterioration that a lot of other areas have.
Yeah. I mean, Microsoft, Alphabet, both down over 30% this year. Apple's down about 15 change. about 16. That's down 3% today. So 18,
Yeah.
we'll call it. But for attribute, as we kind of alluded to, it's try to consolidate a little bit more, held above its June lows still at this time, above its September lows as well. So on an absolute basis and even a relative basis, this is held up of the mega caps a lot better so far. But
Yeah,
we know that could change quick.
we'll see what happens with their earnings this afternoon, that's for sure. But I mean, in looking at it, I mean, it did fall down to a 52-week low, sitting down there at the 130 mark that it reached in June, climbed all the way back up to 176, almost a straight column of X's up from that level.
Yeah.
I mean, that was a massive stem. 3 consecutive sells now, got back down to the support at 136, which is going to be that initial support level that we see now. Rallied up to 152, returned to a buy signal as we touched on, got close to the normalized position, reversed lower. Definitely want to kind of keep an eye on some of those support levels as we're looking toward those earnings announcement this afternoon. We'll see how that holds up tomorrow.
Yeah. Something else too. I want to mention on Apple is that looking for follow through is a good case here, where you have not seen a consecutive buy signal given on that chart this year. Period. You've just seen these one-off buy signals. You got one in March, you got one in May, you got one in July, you got one in October. So if you can put in a higher bottom here and you give a second consecutive buy signal, that'd be a first of the year and a big deviation from the other mega caps. Now, I think that could be a pretty decent setup.
Yeah, it certainly could. I mean, you got that overhead resistance now initially at the 152 point, and pretty notable overhead resistance at 158 moving through from there. You got some resistance from September, and that's also going to be right around where the bearish resistance line, that negative trend line, is coming into play, and right around the midpoint on trading band at that point. So
yeah.
I mean, that's could be some the upper 150s could be a natural. If we did push higher, that would be the next area to look toward in terms of potential movement from here.
Yeah, then beyond that, I think there's a lot of resistance around. It looks like your all-time chart highs at 182. I mean, you got your March, April resistance around 178. All-time chart highs are at 182. And then in August, you also rallied up close to there as well. So there's a lot above that. A lot of work.
But there are kind of steady levels to look toward.
Yeah.
That seem to have been looking at resistance on kind of multiple occasions to kind of look toward moving forward. So hopefully we break through all this after the earnings this afternoon, right?
It'd be great. I'm all for it. Yeah, I mean, you got coming into Q4, big seasonal tailwinds typically behind you around this time of the year. There's also a lot of kind of technical clustering of major support we were coming off of. So there's a case for it, but this year has been unlike many others, and structurally the market's a lot different right now. So it feels like it's really to be seen.
Yeah, I think so. I mean, that's why we look at it from the kind of technical objective point of view, right? I mean, we can try to predict and guess what's going to happen all the time, but at the end of the day, we just kind of do what the chart tells us to do, right? I mean, we follow the signals, follow the indications as they're given to us, and then make the decisions and move on from there and try to keep it as objective as possible.
Yeah, for sure. Well, before we start talking about Alibaba, any other things we should mention to the group?
No, I didn't know if you wanted to dive into Alibaba, because that is
we'll spare them.
You talk about an ugly chart picture. I don't know if you can get much more ugly than that. But
you're going for
it. But yeah, no, I mean, I think that's definitely a point to touch on. I mean, bringing up the China equity picture, right? I mean, we saw some of the broader China, pretty much every broader Chinese equity space was down notably on Monday, with the broader MCHI from iShares down 9.99%, which is top 10 worst single day returns ever for that index. So I mean, it was definitely a sharp deterioration, but China hasn't been a great looking place throughout the past several months from at least a technical perspective, right? It's shown some signs of light. Like we were talking about with Alibaba, I mean, you talk about a wild chart movement throughout the course of the year.
Huge stock.
Right. Started the year in the upper 130s, fell all the way down to the lower 70s within 3 months, climbed all the way back to 124 within a few weeks, fell all the way back down to the upper 70s within another couple months. I mean, it's just been rocking and rolling all over the place.
Almost like 50% round trips.
It is. It's been a lot of movement, that's for sure. And some of the movements look very consistent and constructive. It's just happened. You've given 6 signals in 5 weeks. I mean, it's just been a lot of movement back and forth. And that movement recently has been heavy movement to the downside. So another name kind of similar to Meta, right? We've seen such sharp deterioration. It is oversold, but certainly with the China story too, and certainly with Baba, not an area that you want to be kind of just jumping into because it's washed out. We've seen multiple times throughout this year lower can move lower very quickly. Just because it's
Mhm.
low is not necessarily a reason to be looking toward. And a weak technical picture does kind of support that case currently.
Yeah, no, nothing to add on that. No, I think that's a good call out. Good takeaway.
So not to leave anybody with a sour picture heading into the weekend, but there's certainly a lot of stuff that we'll continue to keep an eye out for. Hopefully some of you listening are going to be joining us in Richmond for our fall symposium next week. So if you are, we look forward to seeing you. Be sure to give us feedback, only good feedback about the podcast though, if you do see us in person.
Only compliments.
Right. That's what
we get all the hate on the comments.
Right. There we go. Well, Will, it's great to be back with you here in person again. And thank you very much, everyone, for tuning in this week. And we won't be having a podcast next week because of that fall symposium. So we look forward to talking to you all again in a couple weeks.